Hello, welcome everyone to NuView Trust's webinar. Webinar today is going to be on real estate syndications, understanding private offerings under Regulation D. We do want to put our disclaimer. So NuView Trust is a passive custodian for alternative investments. We do not advise you. We ask you to go seek counsel from either your tax or legal professionals, CPAs and such, to make sure that you're making the right decision for you. Stacey Bowers is of counsel at Three Pillars Law Group and has almost 30 years of legal experience. She assists the firm's business law and real estate syndication teams with all aspects of representation. She started her career at the U.S. Securities and Exchange Commission in the Division of Corporation Finance and has also worked as in-house securities counsel for 2 companies, guiding them through their initial public offerings and ongoing obligations as publicly traded companies. Stacey's passion is helping entrepreneurs raise capital to fund and grow their business and loves working with and advising founders of startup ventures. Without further ado, here is Stacey Bowers.
Good morning or afternoon. It's morning for me or afternoon for everyone. I am going to share my screen and pull up my PowerPoint, and we'll talk through the PowerPoint, and then I plan to leave probably about 10 to 15 minutes at the end for questions. So I prefer to field them all at the end, but along the way, if something pops in your mind, if you want to put it into the chat or the Q&A section, so it's there when I wrap up my presentation, that would be great. All right, so as Lisa mentioned, I want to talk about real estate syndications today. And my primary focus is going to be, I'm going to give you a little bit of a background. And then after that, sorry, I'm going to advance forward a little bit. I'm going to give you a little bit of a background about securities law generally. And then what I really want to focus on today is I want to talk about the Regulation D exemptions from the registration requirements. And in particular, I'm going to focus on 506B and 506C, because those are the primary exemptions that our clients or that most people use when they're undertaking some type of real estate syndication. And on the flip side, if you happen to be somebody who is passively investing in real estate syndications, it is those 2 exemptions that are allowing those companies to raise capital and for you to then be able to, buy into those particular deals. And then hopefully, if we have time at the end, I will talk about some of the important compliance considerations. I've told Lisa and NuView they're free to share my PowerPoint. I'm not going to cover everything on my PowerPoint today, but I wanted it to be there for future reference. So if you wanted to come back to it. So this slide really is just meant to kick us off and think about the idea of, the whole process of real estate syndication and where do people participate along the way. Because as all of you know, there are different sort of entry points into real estate syndication or different roles that different investors play. So a lot of times people come into that world really just as a passive investment. They're looking for that alternative vehicle to invest their money as opposed to, mutual funds or stocks or bonds or something like that. And then sometimes from there, we see people sort of shift into more of that active role that, maybe they buy their first single family home or they buy a townhouse and they just want to rent it. And so they kind of have that single property, and then maybe they come into a deal and they start to actively participate as a co-sponsor, or maybe then eventually they run their own deal. So it runs the gamut. And this presentation is really just great background information, no matter where you sort of fit into the life cycle of, real estate syndications. All right, so without further ado, let's jump into Reg D a little bit and talk about some of those aspects. So I just want to lead off by saying the primary piece of legislation that governs in this area is, the Securities Act of 1933, and you might often hear that referred to as the 33 Act. And in essence, that is the act that the SEC put into place obviously in 1933, hence the year attached to it. But the goal there was, after the Depression, the SEC stepped in, and their goal was really to create a mechanism that required disclosures, so that as companies were raising money, they were providing disclosures to their potential investors, because prior to that time, everything was really just happening via word of mouth. And so there wasn't a lot of information out there. And as we all know, investors lost a lot of money through that process. But along the way, there are actually some other pieces of legislation just to be cognizant of. So public companies in particular have obligations under the 34 Act, and also some of the liability that can attach in a private offering comes about through the 34 Act. And then I'm not going to touch on either the next two today, but we have the Investment Advisors Act and Investment Company Act. And there are sometimes in this real estate syndication world, particularly if we're talking about somebody who's raising a fund, and then they're going to use the capital in that fund to go out and purchase different types of real estate, there's some implications that come into play, particularly with those two acts along the way in that arena. So as I mentioned, the 33 Act really was the SEC's attempt to just put into place some disclosure regulations. And along the way, they've built out the 33 Act over time. And again, the goal was really, the SEC wanted to get as much information into investors' hands so that they have the knowledge that they need to make a sound investment. And one of the things I like to say sometimes is the SEC has a little bit of a parental point of view. And part of what they're trying to do is their hope is to protect investors. And the way they do that is through this oversight and these disclosure obligations. All right, so let's start a little bit just at the very beginning. And I know you take a look at this slide and you're like, holy crap, how can all of these things be a security? So it's really crazy. I'm going to guess if you're glancing at this slide, there are some things on there that probably never crossed your mind were a security. So for instance, a fractional undivided interest in oil, gas, or other mineral rights. But I really want to focus on two particular things here that are relevant to the real estate syndication world. And the first is the fact that a note is a type of security. And the second is the fact that what is called an investment contract is a type of security. And I'd like to focus on those because I think sometimes there's this misperception that when people buy a note or a promissory note, they don't, or sell a note or a promissory note, that they somehow think because it's called a note and it's not called stock or it's not called a security, that it is not a security under the securities laws, and so doesn't implicate all of those compliance that has to happen. And that's absolutely not true. So anytime a company in particular raises capital by selling promissory notes, they truly are selling a security. And anytime a company sells a security, no matter what form that security takes, they either have to register that security, meaning they have to do a public offering, a traditional public offering, or they have to find an exemption from those registration requirements. Now, there are going to be certain circumstances where a note is not a security. So for instance, if you were ever loan money to your children to help them go to college and you enter into a promissory note, that's the type of note that's not a security. Or we think about, financing our home purchase or our car purchase, and we have a promissory note. They are not securities. But in the context of a company raising capital to use in its business, those notes are almost always going to be deemed to be securities. And then the other thing that I want to talk about that falls into this idea of what is a security is something called the investment contract. And really what this phrase is doing, this is a catch-all. Because if you take a gander through this definition of security, nowhere will you see it saying that, oh, if you buy an interest in a limited liability company, so if you buy a membership interest, that's a security. Or you buy an interest in a traditional limited partnership, that's a security. Those aren't specifically enumerated here in this definition of security, but the SEC created this concept of an investment contract, and that's how they pick up all of those types of ancillary things, bring them within the definition of security, which then means that if you're selling something that's deemed to be an investment contract, that has to comply with the securities laws. So just a little bit of a background on investment contracts. And I'm also going to share a little bit of an urban legend, so to speak. So as Lisa mentioned, I started my career at the Securities and Exchange Commission. So supposedly the reason this whole Howie Test and this idea of an investment contract came about is that there were some people who worked for the Securities and Exchange Commission staying in a hotel in Florida. And at that time, there was kind of one of those, we all think about it if you've ever gotten that call, hey, do you want to come sit through, this presentation, because we're going to then try and sell you a timeshare. So the same kind of thing was happening here. The Howie company was holding a presentation because they wanted people to invest in their citrus groves. So of all things, that's the urban legend. And then ultimately the SEC brought an action against the Howie company, saying that the sales of those citrus groves were actually selling a security. Now, there are a whole lot of other nuances tied up into that, but at the end of the day, basically as a result of this case, the SEC said, anytime a company sells an investment contract. So if they've got an investment of money in a common enterprise, meaning just people are investing money and it's going to be used for a common enterprise. So investing in real estate, and those investors have a reasonable expectation of making a profit. And keeping in mind that profit doesn't necessarily have to mean we're going to make a gain or we're going to get cash. Because for some people, the idea of making an investment in a common enterprise with an expectation of profit could actually mean we have an expectation of having a couple losses those first years, and we're going to use those losses to offset some of our gains on other investments that we have. And then the expectation that those profits are going to come about predominantly from the efforts of others. So this is where we get the Howie Test, and this is the test that in essence means that when a company sells a limited liability company membership interest, they are selling a security. So I'd like to say that some of you might be sitting there or listening to this presentation and thinking, well, that's really weird because I've bought a membership interest in an LLC and no one's told me it's a security. No one's sort of treated it. They haven't had me sign a subscription agreement and do all of those kind of things. So I have 2 points of view there. So the first one is that fourth part, predominantly from the efforts of others. So if you ever invest in a limited liability company and all of the members are actively managing that company, so they're not passive, then there isn't an expectation that the profits are coming from the efforts of others. So that means that ownership interest in that LLC, it's not a security. And so it takes it outside of this test in the investment contract. And then the other thing I would say is that possibly you invested in something, a limited liability company, it was actually a security, but the people that were managing the sales of those membership interests hadn't done their own due diligence and didn't understand that they were actually selling a security. All right, so that's a really high level background. And I like to joke, I'm also a professor at a law school, and I would probably spend 4 class sessions talking about what I just talked to you about in 10 minutes. But let's shift gears a little bit and just take a quick look at kind of, the offering of securities. And then we're going to jump in and we're going to spend the bulk of our time talking about 506B or C. So just to kind of sum up, so this idea of when you sell an interest in a limited liability company to passive investors, basically you're exchanging ownership for money in your company. That's a sale of an investment contract. And so that's a security. And so that company either has to register the securities, do a public offering, which is a huge expensive endeavor, or they have to find an exemption from the registration requirements. Now, there are lots of exemptions out there that allow companies to raise money. One of the primary ones that's used, not just in the real estate syndication world, but actually across almost all sort of private capital raise, is Regulation D. And within Regulation D, there are actually 3 different exemptions that you can rely on to raise money. The first is what's called a Rule 504. I'm not going to talk about that much today, mostly because that exemption means that if a company raises money under 504, they can only raise up to $10 million. And not only do they have to comply with the federal securities laws, but they also would then have to comply with the state securities laws in every state where they make an offer and sale. So between that sort of cap on the amount of capital that can be raised and that obligation to meet state securities laws, most people don't rely on a 504. It doesn't have a lot of bandwidth, particularly in the real estate syndication world. So most people are going to rely on the 506B and 506C offering. And I know we're not talking about it today, but I do just want to mention the idea of crowdfunding. So many times early on, maybe not with a syndication, but crowdfunding can also be a way for companies to raise money. The cap, the amount of money they can raise there is only 5 million, but it can also be an easier and quicker and less expensive way to raise money than a 506B or C. But in the real estate syndication world, those crowd funds, they probably, can't allow for a lot. But maybe if you were buying, your first sort of quadplex or duplex, that might be something to think about. All right, so this is a lot of legal gobbledygook, and don't get too bogged down into it. But that basically the idea is there's section 4A2, and that's the section in the 33 Act that creates this idea that a company can raise capital as long as it's not a public offering. So I like to joke, that's really not very helpful. So anybody who's trying to raise capital and they look at this section, then they might think, well, I have no idea what that means. So that's where Regulation D comes into play. So the SEC put into place Regulation D, and in particular 506B and C, and said, okay, if you do all of these things, then that is going to be something that is not a public offering. It's going to be exempt from the registration requirements, and you're going to be able to do that to raise the capital for your business. All right, so I'm going to leave this slide up for a little while, and I'm going to try and add context to sort of all of the information here. And I want to start with the 506B offering. And I'm probably going to mix and match a little bit here too. I'm going to say with both 506B and C, there's no limit on the amount of money that a company can raise. So there's no cap, there's no threshold. If a company wanted to raise $100 million in a 506B or C offering, they could absolutely do that. I think the other thing that's a little bit fascinating about the world we live in is that I can tell you over about the past 3 to 5 years, more capital is being raised relying on Regulation D exemptions that is being raised through traditional public offerings. And in particular, as of last year, it's a pretty significant difference that most companies now are relying on these exemptions to raise capital to fund their businesses. I also want to say that just because a company is a publicly traded company and you can buy their stock on NASDAQ or the New York Stock Exchange, that doesn't prevent them from also relying on these exemptions to raise money. So just because they have a publicly traded stock, that doesn't cut them off from being able to then say, hey, my next offering I'm going to do a 506C. They're absolutely able to do that, but those shares of stock, they're not going to automatically become publicly traded. So again, just the idea that there's no limit here on how much money can be raised. So now let's take a little bit deeper dive into the 506B. So one of the reasons that a lot of companies will use the 506B as their exemption is because it allows them to raise capital from both non-accredited and accredited investors. So what does that mean? That means it opens up the ability to maybe raise capital from, those type of people who don't meet certain income thresholds or certain net worth thresholds. And I've got a slide later on where we'll talk about, what does it take for somebody to be an accredited investor? But when you're talking about just an individual, it takes either $1 million of net worth to be accredited. So if you don't meet that, that means you're a non-accredited investor. Or if you yourself have a salary of $200,000 or jointly with your spouse or spousal equivalent, partner, significant other, $300,000, you're accredited. So that's really easy. Those people are accredited investors. It's easy to bring them in, but a lot of times companies raising capital, they have a number of non-accredited investors who want to participate in that offering, and the company would like them to participate. Sometimes they're friends, sometimes they're family. Sometimes there are people that they've met through different networking or startup groups that they're involved in, and they want to bring them into the offering. And so they have this mix of non-accredited and accredited investors. So the only caveat here is with a 506B, a company can only sell to 35 non-accredited and what are called sophisticated investors, but it can sell to an unlimited number of accredited investors. So you might think, wow, 35 isn't very many. But the SEC has terms that say, you know what, certain people don't count towards those 35. So if you have spouses and maybe adult children who all reside in the same household and they all purchase into the offering, believe it or not, because of that living arrangement, they're only going to count as one non-accredited investor. So while that 35 might seem like sort of this line in the sand, there's a little bit more wiggle room there than you would realize. But also note that those people have to be sophisticated. So what does that mean? That means that they have to have the knowledge and the ability to really assess this offering. So think back to what I said about the 33 Act. The SEC is a little bit of a parent. It wants there to be disclosure out there. It wants to protect investors. It wants them to be able to make a sound decision. So here, if a company is raising money through a 506B, the SEC says, okay, you can sell to non-accredited people, meaning people that are under those sort of dollar income thresholds. But if you're going to sell to them, they have to be sophisticated, meaning they have to have the knowledge that it takes to really assess the risks of this deal, and in essence, to understand that they could lose all of their money. So there is that sophistication threshold here. The other downside to a 506B offering, and the reason for this is because you are selling to non-accredited investors, is that the company can't engage in general solicitation or advertising. So that means it can't put a blast out there on its website or through LinkedIn or through some other kind of portal that it's associated with and say, hey, we're raising capital, we're raising 10 million in capital because we're going to buy this particular piece of property. So it really sort of cuts down on the company's ability to maybe be able to talk about their offering broadly, which could impact whether or not they're able to get sufficient investors to raise the capital that they need. So there's no general solicitation and advertising. And this next point, this idea of the pre-existing substantive relationship, what that's doing is saying the company has to have a pre-existing relationship with any of the investors in a 506B. And that pre-existing relationship also has to be substantive. And the reason that relationship has to pre-exist is because if it doesn't, then the company is engaging in general solicitation or advertising. Whereas if it already has that pre-existing relationship with the potential investors, then when it starts talking to them one-on-one, that's not general solicitation or advertising. So I think sometimes we throw, lawyers, we like to throw around these terms and we don't think about the fact of like, okay, let's connect the dots and explain how all of this fits together. And that's really how those two go together. And then, as I mentioned a little while ago, the great thing about 506B and 506C, you have to comply with the federal securities laws, meaning the requirements of the exemption itself. But the companies raising money this way, they don't have to comply with any of the state securities laws. Now, that doesn't mean that the state securities commissions aren't going to take a little bit of a, money from this endeavor that you're undertaking. Even with a 506B or C, the company would have to file their Form D with every state where they sell securities. And of course, the company, every state's going to have a filing fee. So while those state securities commissions, they're not going to review their offering, they're not going to have anything to say about it, they are going to require the companies to put the state on notice that they're selling securities there, and there's going to be a fee that companies have to pay for that. So now let's shift. Oh, the other thing I want to say too about a 506B is the accredited investors, they can simply self-certify. So that means unless the company has reason to believe otherwise, they just send a form to those accredited investors. It's essentially a check the box form. I'm sure many of you have seen it or you filled it out yourself. You check the box saying, this is why I'm an accredited investor. You sign it, it goes back to the company, and the company can simply rely on that self-certification from the individual investor that they are accredited. It doesn't need to do any additional digging or verification or anything like that. All right, so now let's shift gears and talk a little bit about, so how does 506C differ from B? So again, no limit on the amount of capital that can be raised, but in a 506C, the company can only sell to accredited investors. So that's a pretty big caveat. I mean, that rules out that idea that you can sell to 35 non-accredited investors. And a lot of times that will preclude the company from bringing in possibly friends or family or those people from their startup groups that they're involved in if they don't meet that accredited investor threshold. But on the flip side, because they're only selling to accredited investors, they can engage in general solicitation and advertising. So that means they can put something up on their website, they can put it on Facebook, Twitter, LinkedIn, so they can get the word out about their potential offering that, hey, we're doing an offering. If you're interested in it, come back to us, sort of fill out this form that tells us you're accredited. We'll give you access to our documents. And so it just creates a bigger pool. It can make it easier for a company to go out and raise the capital that it needs to do that deal. Now, along with only being able to sell to accredited investors, the other downside of a 506C is that the company has to verify that every party that invests in the deal is actually accredited. So that ability to self-certify like you have in the 506B, that goes away. And now the company, it's required to engage in a verification that an investor is actually accredited. So there are a couple of ways to do that. The company could just take on that task itself. And it can do that. It can request tax returns. It can request things like brokerage statements if an accredited investor is trying to establish it through net worth, or many times companies will use a third party to help them with this verification process. I will say in this world, most accredited investors are accustomed to this idea that their status as an accredited investor has to be verified. And many of them, because they have a CPA, they have a standard letter that their CPA can provide that attests and verifies that they are accredited. So while that burden of verification, it's a little bit of a burden, I think generally many accredited investors are used to that process. And so it doesn't really catch them off guard and they're ready to go. And a lot of them have either that letter from their CPA, or if they have an investment advisor, or actually their their lawyer can do it as well. So it's a little bit of an extra step, but it's not as difficult as it seems. So that's kind of a high level overview, sort of talking about 506B and C. And I'm sure some of what I think as I was talking about that, some of what's on this slide has appeared. So, as somebody who represents startups who are doing real estate syndications, typically what I see is those sort of more early people into the process. So maybe it's their first real estate syndication or their first couple of syndications. They're often the ones that are doing a 506B. Because many times a lot of the investors that they're bringing into their offering are friends, their family, they're people that they've gotten to know through their networking groups. And again, many of them might not be accredited investors. And so they want to do a 506B. And also maybe they're only raising, 3 to 5 million in capital. So they're not looking to raise, 20, 30, 40 million. And so they don't necessarily need to have a really large investor pool to do that. So a lot of times those early raisers, they rely on the 506B, but then traditionally what I see as, real estate syndicators move through the process and maybe they're on to that third or fourth deal, then they're starting to get to the point where they're like, you know what? We now are raising, we're raising capital. We're doing a big multi-unit apartment complex. We need $20 million to supplement the loan we're taking out. We really want to do a 506C because we want to be able to engage in general solicitation and advertising. We want to have, a lot more options as far as investors go. And that's the way to do it. And again, typically those, they've started to have a good track record. It makes it a little bit easier for them to do those blasts and raise the capital. So when you think about, who's using them, that's kind of the way that we typically see it in the firm that I work at. All right, so that was a little bit of background. So now I want to dig into, I know it's called a compliance, but I want to dig into a little bit more of the specifics just to provide that knowledge. So let's just circle back and talk about accredited investors. So again, $1 million in net worth. That can, and that can include IRAs, brokerage accounts, all those types of things. One thing to keep in mind here is that an investor can't count their primary residence in that net worth calculation. But on the flip side, they also don't have to count the mortgage on that primary residence. Now, if somebody has multiple properties, they can count those secondary properties to hit that net worth of $1 million. But again, you have to take their primary residence and the underlying mortgage out of that mix. And then the other way that most individuals, we call them natural persons because lawyers like to use the word person and the capital P to mean, natural persons and corporations and all those kind of things. But an individual, they have to have 200,000 in annual income the past 2 years and an expectation of having that in the current year. Or if they're trying to qualify in conjunction with their spouse, the SEC calls them spousal equivalents, sort of what we think of as partners or significant others, people who are residing together in the same household, choosing not to be married. Then it's 300,000 in the past 2 years with an expectation of 300,000 in the current year. One of the things I often have clients ask me is, when does somebody have to be accredited? They have to be an accredited investor on the day they invest, they wire their funds, they sign the subscription agreement. So it's an interesting thing to me because I've done a little digging into this. So that person could be accredited and maybe, a week later, something happens and their net worth, reduces, there's a change in the stock market, but that's okay because they were accredited at the time they made the investment. Other people that fall into this category that can be really helpful is if someone's the director, an executive officer, or a general partner of the company that's selling the securities. That automatically makes them an accredited investor. And the rationale for that is that they're insiders, that they have access to all of the information that they might need. They know a lot about that company. They've got the nitty gritty, and that allows them to have the capacity to determine if they want to make an investment. So those people are accredited investors no matter their net worth or their annual income. And then, I've got some other things listed on here. I don't want to go through them all because I think those are the main ones that we think about when we're thinking about accredited investors. But you can always circle back to the slide and see sort of the different categories. I've also here on this slide tried to walk through, what makes another company or an organization accredited. And I'm going to be honest, like if you sort of look at this slide, you can see the 5 million pops up all over the place. So in essence, if they're managing 5 million in assets, or they own 5 million of assets, or they've got 5 million of assets they've invested, that's going to make those kind of organizations probably fall into this accredited investor category as well. All right, so as I said previously, no general solicitation or no advertising. And that if the issuer, the company raising the capital, has to have a pre-existing substantive relationship with all of the potential investors before they make any kind of offer. So I want to dig a little bit more into this idea of pre-existing and substantive, and then I'll touch a little bit on when does that offer first happen. So what does it mean to have a pre-existing relationship? Well, you better know the person before you start your offering. So that makes something pre-existing. You can also establish that pre-existing relationship through a broker. So if a company is actually using a broker dealer to help it raise capital, if that broker dealer has a pre-existing relationship with somebody, as long as they have that before the offering commences, that also establishes a pre-existing relationship. So what does it mean to be pre-existing? The SEC hasn't really come out with a ton of guidance on this topic, but they've given us a little bit. So there's no minimum period of time, but I'm here to tell you, I would never tell a client that it's enough. Oh, you met somebody yesterday. Today you have a pre-existing relationship with them. Tomorrow they could participate when you launch your offering. That is absolutely not going to sort of meet this litmus test that the SEC has given us. The idea of the pre-existing relationship is you've met this person, maybe you met them on a webinar, maybe you met them, you went to a pitch night and you met them at a pitch event, maybe you're part of a networking or startup group, you've met them there. So now you're starting to establish that pre-existing relationship. So if they're part of your startup or networking group and you've met them and chatted with them for a couple of different times, I'm comfortable that that's a pre-existing relationship. If you, sort of met them one-off and you had a conversation with them, I don't think that's enough. I think you've got to have a couple of more follow-up conversations after that to get to the point where you have a pre-existing relationship. They could be a couple of quick conversations on the phone or something along those lines, but just keeping in mind that, you really have to, if the SEC ever came knocking, you want to be able to show, hey, I really did have a pre-existing relationship with this person. And then also that it was substantive. So it wasn't like I met them at a pitch night. I talked to them for 2 minutes. I picked up the phone. I talked to them for another 2 minutes. And then maybe, I was on another webinar and chatted with them in the chat. That's probably not a substantive relationship. The idea of the substantive relationship is that you're starting to get to know this person enough that you have a sense of, what are their financial circumstances? How sophisticated are they? Have they invested in real estate before? Have they invested in other things? And, they've done a lot of investment, but maybe this is their first time investing into real estate. Do they have what it takes to be able to evaluate the risks and understand, what are the risks of this particular deal? Could I possibly lose all my money? So this idea of a substantive relationship is starting to have an understanding about this person's sort of financial and investment circumstances. And that's what makes something substantive. So again, if we were to put these together and you met somebody at a pitch night and you had a conversation with them, and then maybe you picked up the phone a couple of days later, you had a follow-up conversation, and then the next conversation was, okay, I'd really like to get a sense of your sophistication level. What have you invested in before? One of the things that we do at our firm is we provide our clients with a form that they can kind of walk through and some questions on maybe that third or fourth conversation with this potential investor to start getting a sense of these type of circumstances, their risk tolerance, their knowledge, their sophistication, and those kind of things together. Now you have that pre-existing substantive relationship. And that person could then participate in your next offering that you launch. Now, one of the questions we get a lot here is, does this just have to be with our non-accredited investors? And the answer is no. You have to have this pre-existing substantive relationship with any investor in a 506B offering. So this is a pretty big hurdle to jump through. And this is, to me, this is probably more so than no general solicitation or advertising. This is a little bit of the biggest downfall with the 506B, is establishing this pre-existing substantive relationship. So thinking about, and again, this is a lot of what I said too, but as you're assessing that person, what are some things, what's their education level? What's their job? Are they, well, if they're a broker dealer, they're probably an accredited investor, but, are they a financial analyst? Are they a lawyer? Are they working in the finance industry? Kind of, what's their occupation? Does it give them, access, or are they doing things on a day-to-day basis that they understand investments and those kind of risks and rewards? Again, have they ever invested in real estate before? That's not the be all end all, but are they sophisticated enough that, maybe they have been investing on their own? They've got some brokerage accounts, they've got their IRAs, all of those kind of things. And then the other thing we always tell our clients too is you really want to track that relationship. So we recommend that you keep some kind of tracking device, maybe it's an Excel spreadsheet, and you start keeping these details and this level of detail. And again, this is sort of the CYA, the cover you're behind. So if something goes wrong and the SEC knocks on your door and says, hey, we're really not convinced you had pre-existing relationships with all these people, so it looks like you might have engaged in general solicitation, you can pull out this tracker and say, yeah, no, that's not true. Let me show you how we got to the fact that we had these pre-existing substantive relationships. And this slide is just talking about some of those kind of things that you would keep track of along the way. All right. So one of the things I said is you have to have this pre-existing substantive relationship before you make an offer. So what's an offer? Well, I am here to tell you it doesn't take much for the company to make an offer. So the idea, the minute the company says, hey, are you interested in investing in this particular deal? Here's some information about it. That's an offer. It just doesn't take much to trigger this concept of an offer. So it's really critical, when you're talking to people and establishing that pre-existing relationship, you can talk about what you've done generally as a real estate syndicator or what your company has done generally, or you might talk about past offerings that you've done. But the trick is to not talk about sort of that current offering that you're trying to establish this relationship for, because you want to be able to bring that person into that current offering. So it's a very fine line. It's a very gray area, but you just have to be cognizant of the fact that it doesn't take much for something to be considered an offer. And as you can see below, highlighted in blue, basically the minute like you pique somebody's interest or condition them, then that is an offer. So if you pique their interest because you're like, hey, we're getting ready to buy this property in Austin, Texas. It's $20 million. We're going to raise capital. Guess what? That's an offer. And at that point in time, you've launched your offering and you can no longer create a pre-existing substantive relationship with anyone else. So the only people you could bring into that offering are people that you had that pre-existing substantive relationship with. All right, that's just talking about some of the disclosures that you would include in a document. The one thing I want to say too, differentiating 506B and C, is that 506B offerings, they have disclosure requirements for non-accredited investors, and they're pretty extensive, as you can see. Now, a lot of times it's a startup company, so while it looks like a lot, it doesn't take that much to put this disclosure document together because it doesn't have financial statements. It doesn't have business operations yet. So there's not a lot of detail to be included. And while a 506C capital raise does not require a disclosure document, we really encourage our clients to do that because it's always better to put your investors on notice. Here's the risks of investing in this deal. Here's a little bit of an overview of our business, how we're going to use your money. Here's the return that you're going to get. Why not just put that all in writing too? Because the one thing I want to say is when you're doing these offerings, the company, the executive officers, they have to make themselves accessible to answer questions. And that can be really disruptive when you're trying to launch an offering and you're out there negotiating with the lender for the real estate. So some of the ways to mitigate that time intensive quality that executives face is to put together a good disclosure document, even if you're doing a 506C. And many times that will mitigate a lot of the phone calls that would come your way if you hadn't provided that information to the client or to the investors. All right. I think, sorry, I want to skip just a little bit ahead. I skipped over the idea of the bad actor, but those slides are there. But I also just want to remind you, so again, even though this is a private offering or an offering that's exempt from the registration requirements, meaning the company doesn't have to register its securities, it doesn't have to do that public offering document that then is reviewed by the SEC and is approved, it's still, even though it doesn't have all of those hoops, the company who's raising capital in a private offering is still subject to those liability provisions that show up in the securities legislation. And the idea is that if any person offers securities in interstate commerce, so we live in a world today where it's really difficult to not offer securities interstate, meaning across state lines. So the minute you offer to sell a security in interstate commerce, if the party who's selling that security says, engages in any kind of fraud or makes any kind of statement that's not true, or fails to include a statement that would be really material to someone's decision, and then so it becomes misleading to that investor. They don't necessarily know all the information they need because something material has been omitted. All of those things are going to trigger liability under what's section 617, which doesn't really matter, but they're going to trigger liability for the company that's raising capital. And it's just really good to be cognizant of that. So when you're thinking about your disclosure documents, or maybe you're having conversations with investors, you want to be truthful. You want to provide them with all the material information that they need to make a sound investment, because by doing all of those things, at the end of the day, it's protecting the company down the road if something does go wrong. Not every real estate syndication is a win. Sometimes, you buy the property and you think you're going to fix it up and lease it up and everything's going to go great. And let's take a step back a couple of years ago and the pandemic happens and everything kind of goes south and you don't start making money as quickly as you thought you would in this syndication. And now you're losing renters, or renters aren't paying rent because they don't have to at the moment. So there are just times when a real estate syndication doesn't work out, the purchase of the property doesn't work. But when companies have met all of their obligations and have been truthful and provided all that material information, that is going to protect them from an investor who's lost their money coming back and trying to claim, hey, you violated the securities laws, and so I'm going to sue you sort of under these, I'm going to come after you in these other ways to see if I can recoup my money. So again, thinking about these things, they're really about protection. All right, so with that, I am going to stop sharing my screen. Let me see what I have in the questions. All right, so from the 506B paperwork to the investor includes a business plan, operating agreement, PPM, and subscription. Is there any other paperwork required? So typically with a 506B, yes, you can provide the business plan. You're going to have the private placement memorandum. The subscription agreement is going to be the document that the company and the investor sign, agreeing to how much money is changing hands for what ownership interest. You're going to provide the investor with that operating agreement. The other thing that we typically do, and it's part of that piece of the operating agreement, is we have a joinder agreement. It's a one-page document where the investor indicates that they are joining that operating agreement, that they're going to abide by the terms of that operating agreement. And then I would say also in a 506B, if you are taking accredited investors, you want to have them fill out and self-certify that they're actually accredited. So you'd have that accredited investor questionnaire. And I would also say in a 506B, we advise our clients that if you're taking non-accredited investors, that there's a questionnaire that we provide that you can walk through and they can sign off on that shows exactly why they're sophisticated. So remember, in that B offering, the non-accredited investors have to be sophisticated. So we have a form. It's same idea as the accredited investor questionnaire, where a non-accredited investor can show why they meet that sophistication threshold. So that's how I would elaborate on that question.
Well, that was amazing. It was a wealth of information. I know I learned a lot. I hope the attendees also did. I'm sure they did. And again, I want to thank you for your time, Stacey. I know that when we were at the conference earlier this year, one of the syndicators was asking about that pre-existing relationship and you broke it down. So thank you for that information.
Sure.
Let's see.
I think Lisa, you're going to share my presentation slides.
Yes, I can. So if you'd like that, please just put your email address in the chat and we'll be able to get that information over to you.
And I will put my, I just lost my chat.
Uh-oh.
Oh, I know, there it is. I'm going to put my email. It's on the last slide of my presentation. But I also just put it into the chat as well. It's just Stacey at 3 Pillars. Oh, I think it's 3 Pillars Law. Ooh, I did it wrong. 3pillarslaw.com. That's bad that I don't know my own email.
Okay. All right. We have a couple here that I see. Thank you guys for attending. If you are interested in learning more information from a perspective of NuView Trust and how we can be the custodian of your syndication, please reach out to our relationship management team. You can see the email and contact information there. And we'd love to see you have your fund put onto our platform so that your investors can use NuView as their custodian. So Thank you again. Please watch us on YouTube, Facebook, Instagram, and stay tuned. Follow us on LinkedIn. So we appreciate it and have a wonderful day, everybody.
Great. Thanks, everyone.